Welcome back to this course on infrastructure finance. This is lecture 13 on basically what we have been doing the previous lectures is what we are going to continue this lecture as well. Essentially what we are trying to do is we are trying to look at how do you analyze the project viability, and we looked at various aspects when we started discussing project viability, and we looked at calculating the time value of money, we looked at the discount rate, and the previous lecture we talked about how do you identify the different cash flows which we will use to determine the project viability. Now you should be wondering why we talk so much about project viability, and before we even start implementing the project, what is the reason that we have to talk really so much about project viability. So the reason that we are talking a lot of spending a lot of time about project viability is essentially because of the reason that infrastructure projects are fairly long term projects, and the assets that we actually use in infrastructure projects are fairly specific in the sense that they have very little alternate uses, and therefore it is very important for us to actually realize that before we actually make the actual investment, we have to be very sure about the project's profitability, that is whether the investment is going to actually give some return to the investors, because once we actually make the investment, it is going to be very difficult for us to recover the investment because of the fact that these investments have fairly long lives, and because of the fact that they actually have very little alternate uses. So that is the reason why we actually spend a lot of time to analyze the project viability even before the investment actually happens. So we will continue where we left in the previous lecture. We were looking at an example of a project, and we have identified the various cash flows. To kind of summarize what we have been looking at is we have been looking at a project which actually has a duration of 5-year life, and then for each of the 5 years it actually sells different units, and the price per unit for which it is able to sell the products is also given for each of the years. So if you actually notice, this is a project that is not anything specific to infrastructure, but we are looking at a fairly simple capital budgeting project that is probably seen in many industrial situations. So if you actually look at it, you actually for finding a scenario in terms of unit sales where it starts at a level of 50,000 and then it increases to 100,000, and then in year 4 and 5 it gradually reduces. In fact, this is a trend that you will normally see in any estimations, any financial planning of projects and so on. So the reason is when you actually begin production, you might not be able to produce to the fullest extent right from year 1 because of various reasons. See, for example, if the product is very new, then the acceptance of the product in the marketplace is going to take some time. So you start at a production level which is not at the maximum, but it gradually builds up over a period of time. So in this case we actually have unit sales at 50,000, and it actually increases to 100,000 and then goes on to actually become 50,000 in year 5. Now why is there a reduction towards the end of the project life? The reduction towards the end of the project life is essentially because of the fact that the product, if it is actually becoming a little bit older, the demand in the market can actually taper down, and when the demand tapers down, obviously the sales also will reduce. So essentially the project the product matures, and there is a possibility that the demand might actually come down, and therefore we will actually have lower sales. In terms of the price per unit, what you actually see is we are seeing a price per unit of 150 for the first 4 years, and then the price per unit reduces in the 5th year. Why is the reduction in the price per unit in the 5th year? The reduction is because it is possible that the demand for the product has come down, and therefore to incentivize customers to buy the product, you actually will have to sell it at a lower price. So that is the reason why you normally find the price per unit also reducing towards the end of the project life. So these are some very common trends that you will actually see in any financial planning or any financial investment, particularly in capital budgeting, and this is something that you will have to, whenever you are looking at making a financial projections, you will have to kind of remember this basic rules, in the sense that right from year 1 or right from the first year of operation, we cannot expect to achieve the maximum production, and the price per unit is generally expected to show a decreasing trend with time. So we may not be able to say, we may not be able to sell the product at the same price that what we have been selling right from year 1. And we also discussed the fact that the cost of a new plant was 10 million, and then now the cost can be divided into two categories. There is a variable cost and there is a fixed cost. The fixed cost does not change irrespective of the level of production. So we have assumed it for the sake of simplicity to be constant at 500,000 per year. So this fixed cost, irrespective of whether we sell 100,000 or whether we sell 50,000, it is going to remain the same. So that is why it is called as a fixed cost. And then the second category of cost is called as a variable cost. In a variable cost, the total variable cost will change in terms of the amount of units that is actually produced. So if you actually produce more number of units, then the total variable cost is going to increase. If we actually going to produce a lower number of units, then the total variable cost will be lower. So variable costs are essentially, it could be in terms of the raw material needed to produce a product, the labor that is needed to produce a product, and so on, and it is directly correlated to the amount of output that we produce. And we also discussed the fact that this project needs investments in working capital, and to initially start off the project, there is a need for 100,000 in terms of working capital, and for every subsequent year the working capital investment that is needed would be 10% of the sales of that particular year. So we also have to account for the working capital requirements, and the assets are going to be depreciated on a straight line basis. Straight line basis indicates that the depreciation will be uniform throughout the entire project life. And we might also remember the fact that we discussed there are different types of depreciation. There is something called as return down value, and then there is something called as the straight line. These are the two most common forms of depreciation that is used. In a straight line depreciation, the quantum of depreciation is uniform throughout the project life, and in this case, given the fact that there is no salvage value, the market value of the fixed assets is 0. So the entire amount is depreciated during the project life. So the entire 10 million is depreciated over the 5-year period, and therefore the depreciation each year is going to be 2 million. And the tax rate that we will assume for our calculation is 34%, and then the cost of capital is 15%. So we also discussed the fact that we have to identify the 4 types of project cash flows. We have to identify the initial outlay, we have to identify the annual free cash flows that come from operations, and then we will have to consider the changes to the working capital, and then finally we will have to find out the terminal cash flow. And we actually in the previous lecture determined each of these cash flows. So to kind of summarize, let us go back to what we discussed in the previous class. The initial outlay was initial equipment cost, which is about minus 10,000 K, and then the operating cash flows, which will actually be coming from the profit and loss statement for each of the year. We have estimated for each of the 5 years. This is what I have put here, and then we have the changes in net working capital. So the changes in net working capital is basically the investment needed for working capital in the initial years, and then in the later part of the years we actually have a reduction in working capital, so therefore it is treated as a cash inflow. And then finally the terminal value. The terminal value for this project is 0 because we assume that there is 0 salvage value. So we have identified separately the cash flows associated with the 4 different types. Now we will have to find out the free cash flow from the project. The free cash flow from the project is nothing but sum of the cash flows, sum of all the 4 individual cash flows. So this is your total free cash flows from the project. Now let us calculate the total free cash flows from the project for each of the years. So simply we will have to sum them up to get the total free cash flows. So for year 0 it will be 10,100 K, and for year 1 it will be 2010 K, and for year 2 it will be 4220, and for year 3 it will be 4970, then year 4 will be 4034, and year 5 will be 30. So now we have the free cash flows for the project for each of the years, and we then use this free cash flows and use a suitable capital budgeting technique that we have discussed earlier to find out whether the project is viable or not. So if you recollect, we looked at different types of capital budgeting techniques, such as the payback period, we talked about the net present value, we talked about the profitability index, we talked about the internal rate of return. So we can actually use any of this capital budgeting technique to determine whether the project is viable or not. Now let us start with the net present value. Okay, the net present value, for determining the net present value we need two things. We need the free cash flows which we have got with us now, and second we need the discount rate at which we are going to discount the cash flows, and let us assume a discount rate of 15%. Okay, if we assume a discount rate of 15%, and we use that discount rate to find out the net present value from these free cash flows. Now the net present value works out to be 1933. Net present value works out to be 1933. In fact, I have omitted the thousands. All the values are in thousands if you recollect, because the project is actually the project figures are in millions, and we have not captured in millions, we all captured in thousands. So net present value of the project is 1933,000, so it is about 1.9 million. So you may actually then find out the net present value is positive, so therefore the project is viable. So the decision on this would be to go ahead and implement the project. Now we can also identify the project viability using IRR. Now let us look at calculating the IRR in a simple Excel spreadsheet. So now what we have done is I actually have the project cash flows listed for the 5 different years. So I have calculated the summation of all the cash flows. So the cash flows that you see in the spreadsheet here is nothing but the cash flows from each of the 4 different streams and then summed up, and we have the cash flows for each of the 5 years. Now we can use the cash flows to calculate the internal rate of return, and internal rate of return, if we have to do it manually for 5 years, it actually becomes a polynomial of the 5th degree. It is going to be very difficult to calculate, but we have several functions in the software application such as Excel, which helps us to calculate the IRR very easily. So I am going to now calculate the IRR for this cash flow stream. I am going to use the IRR function that exists in the Excel spreadsheet. So I use the IRR function, and then I actually use the cash flow values for the 6 years, that is from year 0 to 5. And if I use this 6-year values, and then if I go and press enter, I actually get an IRR value of 22%. So IRR is greater than the discount rate that we have used of 15%. If we assume that 15% is the cost of capital or the required rate of return, IRR is greater than the cost of capital or the required rate of return. So therefore the decision should be to go ahead and accept the project. Okay, so this is a simple capital budgeting example that we did, where we actually used the project forecasts and then evaluated the viability of the project using a suitable capital budgeting technique. Okay, now this is a course on infrastructure finance, and therefore what we will do is we will take up another example. This time we will actually take up an example of an infrastructure project and then see how do we actually use how do we actually do a capital budgeting decision in that case. So the example that I am going to discuss with you is an example of cogeneration power plant, and the power plant has a capacity of 250 megawatts. So in fact if some of you are not familiar what is this cogeneration power plant, let us take a couple of minutes to discuss what is a cogeneration power plant is. Remember, we are talking about a power plant. A power plant generates power using fuel, and this power is actually sold to different consumers, and the project gets revenues from this sale of power. And the power that is generated from the power plant can be sold to industries, or it can be sold to various distribution agencies, which then distribute this power to several other smaller consumers. So for example, today many of the power generators, they sell the power that they generate to what is called as your state electricity boards, or the various state government owned power distribution companies, and these distribution companies in turn sell the power to various residential and individual customers. So individual customers do not directly purchase the power from the power generators, they actually purchase power from the distribution agencies. So a cogeneration power plant, before we actually talk about the cogeneration power plant, we should also understand the fact that there are several ways in which we can generate power. Broadly we can classify the technology for generating power into 4 categories. The first is your idle power, where we actually use energy from a water source to generate power, and then the second is your thermal power, in which we actually use a fuel to generate steam, and then the energy of the steam is used to drive the turbines to generate power. And then the third category is your nuclear power plants, in which the energy from nuclear fission is actually used to generate steam, and then this steam is again used to generate power. So if you really look at it in some sense, both the thermal power plant and the nuclear power plant more or less actually use the energy to generate steam, which in turn is used to generate power. And then the fourth is actually what is called as your renewable energy sources, or the non-conventional energy sources, and you have several ways in which you can produce power from non-conventional energy sources. It could be like wind energy. We actually use energy from wind to kind of generate power from a wind turbine, and then increasingly these days you actually are generating power from photovoltaic cells, so that is a solar energy. So there are different ways in which you can generate power, but this example that we are talking about is an example of generating power from a cogeneration power plant. So what is this cogeneration power plant? So cogeneration power plant falls in which of those 4 categories that we talked about? Cogeneration power plant is actually a thermal power plant, but this is a plant that actually generates both steam and electricity. So that is why it is called as your cogeneration. It generates both steam and electricity, and the outputs from such a power plant are 2. It basically both steam as well as electricity. Okay, now we have the following estimations for the prices at which they will be able to sell electricity and steam. See, normally in an infrastructure project, particularly in a power sector, we actually have a power purchase agreement, and a power purchase agreement determines at what price the power generated is going to be purchased by the consumer or the distribution company, and so on and so forth. So, in this case, given the fact that it is a cogeneration power plant, there are two different outputs, both steam and electricity, and let us assume that there is a steam purchase agreement and a power purchase agreement, and the rates that are indicated in the power purchase agreement is as follows. The rates for electricity is 40 per megawatt hour, and the power purchase agreement provides for a 6% annual escalation in electricity prices. So, that means in year 0 the price of the power in the price of the power is going to be 40 megawatt per hour. I beg your pardon, it is not in year 0. In the first year it is going to be 40 megawatt per hour, and then for every subsequent year there will be an annual increase of 6%. Similarly, the price of steam as specified in the steam purchase agreement is 4 per 1000 pounds, and it specifies for a 5% annual increase. So, remember, when you actually sign an agreement for purchasing electricity or steam, it actually gives a lot of credibility and comfort in terms of revenues. A power purchase agreement clearly specifies the price at which the power or steam is going to be purchased, and therefore it gives a lot of certainty for the revenues for the project. So, if there is no power purchase agreement, then there is a lot of uncertainty in terms of revenues, whether the project will be able to find a buyer, and even though there is a buyer, at what price will the buyer be able to purchase the power that is being generated. And for a power plant, it is also important that we have an assured supply of fuel, because unless until the fuel is available, it is not going to be possible to generate power. And like a power purchase agreement, in many cases power plants actually have a fuel supply agreement. A fuel supply agreement is an agreement with the fuel supplier which ensures uninterrupted supply of fuel for the functioning of the power plant. So, in this case the fuel for the power plant is natural gas. So, remember, thermal plants can actually generate power from variety of sources. It could actually be from coal, it can actually be from oil, it can actually be from natural gas, and so on. So, the example that we are talking about is a natural gas power plant, and the cost of the fuel of the natural gas as specified in the fuel supply agreement is 3 per million British thermal units. So, this is the metric that is actually used to price fuel, and in terms of British thermal unit, and again in a fuel supply agreement it provides for an annual escalation of 6% on the fuel price. Now, we should actually be aware that in many cases, given the fact that these projects are actually going to have a very long economic life, power plants can actually have a life of 20 years, 25 years, 30 years, and so on. So, therefore, it is a very standard practice to assume a constant annual increase. In reality, the constant annual increase might not be constant, but actually can vary at the margins. But when we are actually making a financial estimate, it is a usual practice to assume a constant increase in prices or costs. And it is also specified that the plant functions at 90% capacity. Now, the plant has a capacity of 250 megawatts, but very rarely we will actually have situations where the plant functions at 100% capacity. In fact, most of the plants will actually function only at about 80 to 90% capacity, because of the fact that the plant might need shutdowns for maintenance. The plant might actually have any emergencies in which the capacity at which they function will have to be pulled down, and so on and so forth. And so, if you are really looking at functioning at 90% capacity, then what is the kind of a maximum electricity production and the steam production that can actually be made, and in tune with the production, what is the kind of a natural gas requirement, what is the kind of fuel requirement that we actually need. So, the table actually gives the electricity production, steam production, and the natural gas values for year 1. For each of the years, for each of the years. So, let us see how these numbers are calculated. So the capacity of the plant is 250 megawatt. Now if you are talking about a plant generating at 100% capacity, so if you remember, electricity generation is always electricity is always measured in terms of megawatt hours. So at 100% capacity, electricity generated per year would be 2050 megawatt. There are 24 hours in a day, and then there are 365 days in a year, and if you actually calculate it, this will give you 2190000 megawatt hours. So if the plant functions at 100% capacity, then the amount of electricity that will be generated in 1 year will be 2190000 megawatt hours, but we are assuming that the plant will function only at about 90% capacity. So the at 90% capacity utilization, it was going to be 0.9 multiplied by 2190, and this is nothing but 1971. So this is the electricity production that the plant will produce every year. Okay. So similarly, we actually do the same calculation for the steam production. Steam production at capacity, at 100% capacity, is 150,000 pounds per hour. So pph is pounds per hour, and if it actually functions at 100% capacity, then the total quantity of steam that gets produced in a year is 1.314 million pounds, 1.314 million pounds, but we are not functioning at 100%, we are functioning at only 90%. So therefore steam production in a year is going to be 1182.6 million pounds. Now we need to actually find out the electricity production and the steam production, because this is important for us to actually find out, to estimate the revenues that are going to be generated for each and every year. Revenues is nothing but the quantity of electricity that is generated multiplied by the price of electricity, plus the amount of steam that is produced multiplied by the price of steam. So we will have to first determine the steam production and the electricity production multiplied by the prices to get the revenues. So that is the reason why we are actually going through these calculations. And then we also have the fuel, and the cost of the fuel is determined by the amount of fuel that is needed multiplied by the price of fuel. So in this case, the natural gas requirement is 1950 million British thermal unit per hour. So that is a fuel that is needed if the plant is going to be functioning at 100% capacity, and the total fuel requirement per year is going to be 17082 billion British thermal unit. Again, we are not looking at 100% capacity, we are going to function only at 90%. So therefore at 90% utilization, the natural gas requirement is going to be 15373.8 British thermal unit. So this actually gives you a broad metric in terms of how much of electricity is going to be produced, and how much of steam is going to be produced, and how much of natural gas is needed for producing that electricity and steam. Next we go and look at some other parameters related to the project. We also have to account for the operating and other cash expenses. Earlier we talked about the natural gas. Natural gas is just the fuel expense, but in addition to that there might be several other expenses. For example, salaries have to be paid, there would be expenses related to administration, there could be expenses related to office, and so on. So there are several other expenses, and we assume that in the first year these expenses are amount to about 8 million per year, and we also estimate that these expenses will increase 5% on a yearly basis. Now this is again an estimate. See, for example, the actual increase may be more than 5% or less than 5%, but at the time we are actually making the projections, determining the viability, we will have to choose some level of annual estimation. So we will have to choose something that is reasonable, and the most common metric that is actually used to determine the annual increases is the average inflation levels. So if the average inflation has been about 5% in the last couple of years, people use that as a way to estimate the future escalations. The tax rate is assumed to be 40% on the project, and let us assume for the sake of simplicity the working capital investments needed are negligible. So in the previous project we assumed that there are working capital investments that are needed and it has to be factored in, and in fact working capital requirements are commonly needed for almost all the projects, but for this project, for the sake of simplicity, we will assume that there are negligible investments that are needed for working capital requirements. And the total investment that is needed, so this pertains to the initial outlay. The total investment that is needed is 113.508 million, 113.508 million, and then we are actually getting the initial capital from two sources, 25% of it from equity and the remaining 75% by way of debt. Again, this is a very common feature that you will actually find in infrastructure projects, where a large part of the project cost actually met by way of debt, and to a certain extent this also benefits the project, because then having a substantial amount of debt reduces the project cost. So in this case we assume that the entire project is funded with about 25% equity and 75% debt. So when we assume a 75% debt, that loan amount will work out to 85.131 million. So this is the total loan amount that is needed, and there are some conditionalities, features of the loan. The loan has a term of 10 years, and then the interest rate is 10% per annum, and then the principal repayment varies with the project life. In years 1 to 3 the principal repayment is 5%, in years 4 to 7 the principal repayment is 10%. So what we mean is 10% of the total loan is paid in years 4, 5, 6 and 7. In years 1 to 3 5% of the loan amount is paid each year in years 1, 2 and 3. In years 8, 9 and 10 we pay 15% of the principal. So 15% of the total principal is paid in year 8, 15% in year 9 and 15% in year 10. So if you look at it, the entire principal, 100% of the loan is repaid by the end of the 10th year, but the repayment is not equal, the repayment changes every year. So this again is a very common way of structuring a repayment in many infrastructure projects. In the initial years the project might not have adequate cash flows, so therefore the payment is structured in such a way that the repayment increases with time, and in the later part of the years the repayment is a higher rate as compared to the initial years. So sometimes this is also referred to as the balloon repayment. So like a balloon which actually kind of increases with when you actually keep when you actually blow more air, as the time progresses the repayment also increases. So we have actually now all the essential elements that we need to find out the cash flows and determine the project viability. The one missing information is your cost of equity. The cost of equity we assume to be 28%. Let us say we have discussed the ways in which we determine the cost of equity. We use a CAPM model, we use the risk free rate of return, we use the beta and then the market premium to determine the cost of equity. But for this project let us assume that we have used the values for risk free rate of return, beta and the market premium, and using these values we have determined the cost of equity to be 28%. So with these values we are now in a position to determine what is the what is the cash flows for this particular project, and thereby also determine the project viability. So what I will do is I will leave it to you to use the discussions that we had in the previous class to determine the various project cash flows and also determine the project viability. We will actually continue the discussion from here in the next lecture. This is so far we have been really looking at different ways of evaluating a capital budgeting project, and then we talked about the NPV method, we talked about the IRR method, and so on. So the question for you is when we actually have conflicting recommendations from the NPV and the IRR methods, how do we actually choose the projects? So for example, if the NPV is negative but the IRR is positive, or if the IRR actually is higher for project A as compared to project B, but it is actually the reverse as far as NPV is concerned. NPV of project A is higher and instead of project B. So if you really have these kinds of conflicting recommendations between NPV and IRR methods, which of these methods do we actually choose? So think about this question, and we will also discuss this in the next lecture.